Hi, Rob B here with Rob D, and we've got a big task on our hands this week. We're going to take the coronavirus, and we're not going to, unfortunately, give you a cure, but we are going to look at it rationally. And then we're going to look at what the future, not just for property looks like, but for the whole world.
Welcome to the Property Podcast, where every Thursday morning, property investors come to be informed and inspired. Today, Rob, we're not making predictions about what's going to happen as such, but we're going to try to step out of the day-to-day, hour-to-hour news cycle at the moment and to talk about what potential longer-term outcomes could be from the coronavirus.
So we're going to be quite bold here. We're going to look at the coronavirus. We're going to look at what's going to play out or potentially play out in the coming months and years. Not just from a property perspective, but for the world economy. So, Rob, I'm interested. There's so many ways this could go, and lots of people have an opinion. But what's your opinion? What are the scenarios that could play out here? I'm not going to pin you down and say, well, not just yet, what's going to happen, but what are the potential scenarios?
Okay, well, short term, I think we can agree that everything's going to be a total mess, especially in terms of the logistics of property. Because we've had economic events before, right? But we've never had one where you can't get anywhere or do anything. So what does it mean for lettings? What does it mean for construction? What does it mean for actually being able to move house? Can you pick up the keys and move into somewhere that you've arranged to sell? Who knows? It's just, there are so many unknowns around the short term. So it's going to be weird. But beyond that, it seems to me that what the government is trying to do is effectively just hit pause on everything. If you can just hit pause for a few months, keep everything frozen as it is, then when the restrictions are lifted, everything goes back to exactly how it was, then everything's great. And you look at the GDP chart in the future and you see this really weird dip for a quarter and go, what was going on there? Oh yeah, that was a coronavirus. That's the intention. And there are lots of reasons why I think that could actually, or some variation of that could actually play out. But there are other scenarios that people are talking about as well. So there's the possibility that it takes a lot longer than expected for everything to return to normal, because that hitting pause doesn't work. You end up with higher unemployment and it takes people a long time to get their confidence back. There's talk in some circles around a corporate debt crisis because companies are losing such huge chunks of their revenue. And then there's concerns that the stimulus itself, the thing that's designed to solve the problem, actually creates a problem because you've got all this new money in the system, which causes inflation, which causes interest rates to rise and so on. We can talk about which of those scenarios we think is the most likely, but those seem to be the main opinions that are on the table at the moment.
I think there's a big one missing there as well. I think scenario A and scenario B absolutely could play out. I think scenario C is similar to A, where you have that V shape, but because of the stimulus, and we talked about this on Friday, because of the stimulus in place, not only does it come back up, but then it continues to shoot up because so much money has been placed into the system. And that could play out as well. So you've got three scenarios. You've got the everything carries on as it was just a few months later, and we talk about it, and we can tell good stories about in my day. You know, it's our second World War. We get a story to talk about. You've got the Armageddon scenario, which you've kind of highlighted, where everything goes wrong and nothing works. And then you've got the, actually, we recover quickly, but all the money in the system then kicks on and pushes us into a boom cycle.
Yeah, so I think the debate here is, do we get some kind of catastrophe now? If not, then are we just storing up some kind of greater catastrophe for the future?
Which would be typical of the 18-year property cycle. You know, that's what we'd expect, that you have this stimulus in, you go into a boom, and then a crash happens, a bigger crash. So the crash doesn't happen now, but it's almost kicked down the road for 5 to 7 years, and that's when it plays out. That's what cycles have shown us before. Now, it's historic cycles. It doesn't mean it's a future path that is guaranteed, as we know. But because we've seen it play out so many times through history, it wouldn't come as a shock. And it's not necessarily, like you say, a good thing either. You know, a crash today, a crash in 5 to 7 years, even if you have time to prepare for it, neither of them are great. I prefer the one further down the road than now, but neither are great in some respects. The preferred option, I guess, for the most rational people would be option A, which is we just go back to where we were in a few months' time with plenty of stimulus in the system to make sure that happens.
Yeah, and that's why people talk about recession, but I don't think this is an ordinary recession. And yes, you can always say it's different this time, but this time I think it really is different because it's so unusual to have a situation where the reason for the fall in output is that no one can leave their house. No one can produce anything. No one can buy anything. That's not normal. Normally, when you get a recession, it happens gradually. It takes time as people gradually lose confidence and they start shifting their little micro decisions and cutting back and being a bit more fearful about their job and that kind of thing. The neighbour loses their job and they start worrying about theirs. So it takes time to go into recession. This time, it's happened almost overnight. Of course, we're going to go into a recession. But what you don't normally get is this enormous stimulus at the same time, because normally that wouldn't be a sensible thing to do. This time, you could argue about it. I think on the whole, it probably is a sensible thing to do. So yes, recession, definitely. But is this a type of recession that rumbles on for a few years and it takes time to sort out? Or does it bounce back within a quarter? For me, I think it's probably somewhere between the two. I think it's probably a bit optimistic to go, you know what, in 3 months' time, everything's going to suddenly snap back to exactly how it was before. Because in reality, I don't think that the government can prevent a single job from being lost. It will take time for people to get their confidence back a little bit. It will take time for things to ramp up. So I think you could see it taking the rest of the year before things truly get back to how they were. But that's very different from one of those grinding recessions that goes on for years. And because that stimulus has gone in, that takes a bit of time to work through the system. By the time it does and people's confidence returns, now I can see what you're saying, Rob, about going into that boom, which of course does inevitably sow the seeds for a future crash.
So before we go into what does this mean for property investors and break down each scenario A, B and C, I think it's worth briefly touching on what things will have to happen for A, B and C to play out. So scenario A, as a reminder, is that we come out of this within a reasonable time frame, some point this year, and because of the stimulus, we end up roughly where we were before. So Rob, what needs to happen there is that the coronavirus doesn't hang around for too long, or at least the worst of it anyway. People can get back to work fairly quickly. We put just the right amount of stimulus in, not too much, not too little, like Goldilocks would say, just right, and life carries on. Is there anything else you'd add to that?
No, I'll just flip it and use the same factors you just mentioned to kind of list out risk factors. So what are the scenarios that will prevent scenario A from happening? Well, the virus goes on for longer than people are talking about, or it comes back. It comes back in winter, which is also a possibility. That might happen. We don't know. Unlike seemingly everyone on social media, I don't have a degree in epidemiology, so I can't really say. What else? The government stimulus might not be enough. And I think to an extent, like I've said, that will be the case. I don't think it's possible that the government can stop a single job from being lost. There will be some kind of fallout from it. And then the other one, too much stimulus. Well, I don't think we'll see that until further down the track. So even if there is too much, I think we'll initially go back to normal and we won't see the effects of that one later. The other risk, I suppose you could add to that, is around people's psychology, and that's what you could never be sure about. It's possible that having been through all this, people are just more cautious. We know that the savings rate in the UK and most countries is really low. This might have been a shock that causes people to cut back and behave differently, even if they haven't lost their jobs. Psychology, or sentiment, as you tend to call it when talking about the markets, is such a big factor, and that is also an unknown.
It really is, and that's something we'll come back to later for one of the other scenarios. But let's move on to scenario B. And scenario B is our doomsday scenario. So the coronavirus will go on for a lot longer than probably most people are anticipating. There are lots of different projections out there, but this is a year-plus job. The coronavirus drags on, and the economy has to shut down in a big way. And because of that economic shutdown, we go into a depression possibly, and there could be some political uncertainty around the world. People could become very angry in time if this is allowed to continue and we don't feel there's a solution coming. And then we'll turn to alternative options of leadership, which tend to be a little bit more dramatic when you look at history. Populism comes to mind. For me, Rob, and this is something I've been giving some thoughts about, and this is quite terrifying to say it, but I actually think there's one man who will have a huge influence on whether scenario B plays out or not. And that's Donald Trump, because the biggest economy in the world is still America. Obviously, we talk about China a lot, that everyone talks about China a lot, but without doubt, America is the world's biggest economy. And if America leads this well, puts the right level of stimulus in, handles the virus well, puts lockdowns at the right times, then the country could be in a good place. But if it doesn't, and Trump calls it wrong, and belittles the virus, doesn't take it seriously, so the economic stimulus he puts in doesn't work, or he puts the wrong stimulus in the wrong places, all these things could play out. And whether we manage our own affairs in the UK well with the virus and the economy, if America messes it up for the world.
That's a really good point, and it's one that hadn't really occurred to me until you started saying it. But because everything is so globalized, one country getting it right, unless that one country is America, probably doesn't totally solve it, does it? Because let's just say the UK absolutely nails it and everyone's feeling great. The UK market doesn't operate in isolation. So if the American markets are still down, everyone in America is still nervous. There are travel restrictions in place that have an effect on trade. Global supply chains that rely on the US in some way are affected. Then things don't snap back. So you kind of do need all the major countries to get it roughly right.
It seems that the world's second biggest economy, China, is getting it right. It's early days, but it does seem that the measures they're putting in place seem to be working, at least as the virus is concerned. And they seem to be very clever with their economy. The way they manage their economy has been a masterclass, really. And I think that will continue. So surprisingly, or maybe not for some people, I think China will be okay. It's how America handles things from here. And other things that you could possibly see play out if scenario B takes hold is not just populism, but nationalism, a distrust of foreigners, a distrust of foreign lands, a return to people going, right, let's just insulate ourselves from the world because of everything that's played out. And this is a very grim scenario, but this really does come down to the virus being around for longer than anyone's anticipated and the world's biggest economy, America, really messing things up.
That is all sounding pretty grim. I think there's also a less dramatic implication of the virus just going on for longer than people expect, which is this thing about how long can the government keep everything propped up for? So there are lots of very big, very indebted companies out there, many of whom have lost the majority of their revenue. So if you look at the obvious ones like airlines and plane manufacturers and hotels, their revenue will have at least halved. I'm sure it's actually far worse than that. And that's going to put them under a lot of pressure. Governments can prop that up for some amount of time, but can they prop it up for a year? Will these companies be able to refinance their debts? They probably will if people have faith that this is going to be a short-lived kind of thing. But what if sentiment shifts to thinking we're in this for the long haul? Then are they going to start having trouble there? So what you say about the more political side of things, Rob, I think is a great point. But I think there are also more kind of pure economic risks from this extended time frame scenario as well.
Now, a way they can get through it for a longer period of time is for the government to put more money into the system, more QE, and use QE in different ways, not just buy bonds like they do in the UK, but in America, they do underwrite debt and they do implement their QE in different ways, as well as bonds. Now, if the UK and the US do that, and they do that for longer than they were expected, and we get through it, it is very hard to unwind that. And that's where we move into scenario C, where we've pumped lots of money into the system. Now, one of the effects QE has is that asset prices go up over time. It's not immediate, and this is something we talked about last Friday in the market update podcast we gave you, but it will happen in the medium term. Now, let's say this lasts for a year, 18 months, longer than anyone's expected. More money's been put into the system than expected. Assets then are going to rocket. Not immediately, but it won't take that long either because there's so much money there. That's one way scenario C could start. Another way scenario C could start is actually this all goes away a lot sooner than anyone's expected. So it's not 3 to 6 months, which seems the most popular opinion amongst people for us to be through the worst of it and start and get back to normal. But actually in 3 months or less, the world suddenly sorts itself out. Loads of testings available. We get a bit more savvy with how we treat it. Death rates come down and people get back to work. If that happens sooner than expected, we've already put too much money in. So whether we put money in for the long term or we put money in and this is a short term scenario, then option C could play out. And that means that we not just go back to normal, but we go from normal into a boom cycle. And that also could happen because of sentiment, because the opposite could take place. So people could come out of this coronavirus era that we're in and feel, actually, you know what, life is precious. I'm going to celebrate. I'm going to book that extra holiday that I wasn't planning to. I'm going to go out and go on a few more fancy dinners. I'm going to really enjoy myself. I'm going to appreciate life for what it is because it is so fragile and so precious. And people spend more, maybe more open to taking on a little bit more debt than they would normally do. I'm personally generally optimistic and I'm already thinking about what I'd like to do, what changes I'd like to make, how I'd like to celebrate and treat others as well in my own life. And I'm sure I'm not alone. If we have the combination of that uplifting general sentiment and a celebration of life and financial stimulus into the market, Those two things combined only can result in a boom and a boom cycle, which will then take us through into what's a more typical 18-year property cycle, but far more aggressive than it would have been, say, 6 months ago. As we've already said on Friday's podcast, we were expecting this 18-year property cycle to have a boom, but not as aggressive as the last 18-year cycle. It could be even more aggressive than the last 18-year property cycle, which would see property prices doubling in short periods of time because of all the stimulus and the lust for life that people have. But then the consequence of that is a big correction in the financial markets at a later date. So while some people, Rob, may get excited by that scenario, it's not the perfect scenario.
No, but if that does play out, it does show you where the end of this cycle is going to come from. Because for a while I've been thinking, well, how do you manage to get a crash where interest rates are next to nothing? So the answer to that might turn out being you end up with inflation from all the stimulus that's gone in. You also potentially have all this extra demand, and supply was as it was, or supply is even tighter because it takes a while for things to get back to normal. That causes inflation, that causes interest rates to rise, and rates being high puts more pressure on people who have debt. And then at some point you get your trigger and there's your crisis. And that's a possibility. So for me, it comes down to this question. Do we throw out the cycle at this point? Is the cycle broken? Because in the past, the only thing that stopped the cycle from playing out is wars. Is this equivalent to a war? It just shakes everything up to such an extent that none of that stuff applies anymore. Maybe. The other possibility is that this is actually more of your typical mid-cycle, okay, for weird reasons, but you'd expect to have the stock market diving at around this time anyway, and it actually perfectly sets up the boom and then the crash. We can come to semi-informed opinions about which of those we think is the most likely, but you can make a decent case for either.
So, Rob, I said at the beginning that I might put you on the spot. You've got scenario A, we carry on in a few months' time, as things were, and a moderate cycle moving forward. B, doom, or C, boom. So what do you think is most likely to play out? I'm not going to put you on the spot and say which one will, because we can't say that, but which one do you think is most likely? And combined with that, if it's a different answer, which one would you prefer to see?
I'll preface this with the fact that clearly I don't really know what I'm talking about. No one does. The global economy and everything that goes into it, and all the individual actions of billions of people that make up that economy, is not something that anyone can predict with any degree of certainty, however confident they seem to be. If I had to say which I think is the most likely...
And you do, Rob, because people will feel shortchanged otherwise.
Then in service to the nation, I would say I think it's scenario C, but not necessarily with this really neat V shape.
And which would you most like to see? A, B, or C? I'm guessing it's not B.
Which would I always like is a difficult question. For the world, I'd prefer scenario A. I think it would be better for everyone if you didn't have booms and crashes and everything carried on a pretty even keel. As an investor, scenario C produces far more opportunities. Far more opportunities to get things horribly wrong and go broke, but also opportunities to get it very right and do extremely well indeed. So there's a bit of fence sitting for you, Rob. You've got two completely opposite answers out of me.
It may not come a shock to long-time listeners, though, that I completely agree. I think option C is the most likely of the scenarios to play out. But, of course, for the world, I think option A would be better. But because option C is the most likely, it might not be right, it might not be fair, and you might not agree that people will prosper out of it by knowing this and others will miss out and others will buy at the wrong times and then get themselves into financial trouble eventually down the road. It isn't great, but that's why we broadcast this. That's why we talk about it, to educate as many people as possible about what is happening. And then you've got a choice. You can decide to be rewarded by the cycle or be punished by it. But if you're educated, then at least you can make that informed decision. And that's what we're going to carry on doing over the coming weeks. Every Friday, we're going to continue with our market updates. So there's no Hub Extra this week. What we want to do is draw your attention to the podcast that will be going out tomorrow and on future Fridays for the next few weeks, where we can keep you updated and we can talk about these scenarios in the future, scenario A, B, and C, and what seems to be playing out. The interesting thing is, it shouldn't take too long to see which way this is going. We're going to get information and data that's going to be able to guide us quite quickly. Option A and option C are great for property investors. Option B isn't great for anyone.
It isn't. And I think it's worth mentioning as well that in the very short term, as in next couple of months, it's going to be messy. there'll be some opportunities in there as well. But in property, as in pretty much every other industry, there are so many unknowns about how to deal with different situations that have never cropped up before, and how to try to keep some kind of business as usual going on despite all the restrictions. So we'll be doing our best to cover that on the podcast as well, both in the main podcast and in Ask Rob and Rob on Tuesdays, because there's going to be loads of questions about how to deal with that. And we'll be sharing insights from how our business is coping with all that. So we'll see you again tomorrow for our market update. Until then, bye-bye.
Bye-bye.